Welcome to the Investing Podcast presented by Tusk Media. This is Outsider Trading, an audio and video deep dive into the people, places, and things that we find most interesting in the market.
Hey everybody, welcome back to the Investing Podcast. I'm Andrew Hall. Joining me today, Ben Nye. Today we're going to be talking about JP Morgan, which just released earnings. And we do this almost every quarter. It seems like we look at a number of banks. Today we're going to look at JP Morgan. It's nice they report a little bit early on the earnings cycle. You get to hear a little bit about what's going on, get a little bit of a read-through on the economy, and especially as we look at a lot of things like, the new tax bill, what the expectation is for interest rates, things like that. It's nice to have an early year read-through and somebody that's actually given commentary on that, at least through their own lens. So Ben, starting right off, initial observations, good quarter, bad quarter, great quarter, awful quarter. What's the impression?
It was an all right quarter because they hit basically everything they needed to hit, but they also took a big one-time charge related to the tax bill. They do see their tax rate will be 19% in 2018, but they didn't really give much guidance beyond that. And that's kind of what the market looks to in order to build out its models for the subsequent year. JP Morgan will have an investor day in February where they go through their expectations in a little more detail. A couple of high points, though, is that they actually expect more rate hikes than the Fed expects, and they expect more rate hikes than the market expects. Right now, the JP Morgan is baking in 4 hikes. Fed expects 3, and the market expects 2. They also expect that the tax bill will add 20 to 30 basis points of growth, both in 2018 and 2019. So the whole theme of the report and the theme of the conference call was essentially that economic acceleration is a given, and how is JP Morgan going to capitalize on that? How are they going to use capital when they have all this more money coming in? So that was about the theme of the call. There wasn't a ton of micro commentary that was required because that wasn't the story.
Mm-hmm. So from your perspective, and this is actually great timing, we'll have our macro webinar coming up in just a couple of days here on the Tusk Media YouTube channel, so check that out. But we kind of had a preview of that today in discussions here within the office. We do it internally before we make it public on YouTube. But, from our perspective, it's a little bit of a split jury in terms of what the actual economic growth is going to look like in 2018. And if you read into the real impact of what the tax bill could or could not mean, you also get varied expectations. But a lot of really smart people are saying they think, a couple basis points is all we can really read through in terms of GDP growth. But JP Morgan taking a little bit more bullish stance. Does that make you nervous? Do you think they're well grounded in that assertion and that expectation for more growth? I mean, again, you mentioned it earlier, but expecting 4 rate hikes versus 3 from the Fed versus 2 from kind of the implied expectation from the street. What are your thoughts? I mean, are they on solid ground to just assume that will happen?
I think they're on solid ground to assume it will happen. But if we take a step back and we look at actually the economy, and we're talking about a 20 to 30 basis point improvement in growth, yeah, I mean, that'll change things at the margin. But, I mean, it's not like this is the game changer that everyone's want. I mean, we should have 2.5% growth anyway. We should have more growth. Our wages are going up for prime from age 25 to 54 at 3.5% a year, according to the Atlanta Fed. I mean, there are a lot of things that it should be the story, but the tax discussion is kind of taking the cake. As far as JP Morgan's expectations, they do say that they're not really baking in a ton of acceleration into loan growth. But interestingly, what they do say is really they just kind of go back to the math of it all. So they say earnings are going to look better. What does this mean? It means that capital markets are going to become a little more attractive. So when they say that, they mean like equity trading, things like investment banking, companies coming to the market and going IPO or acquiring another company at a more elevated price because the earnings now look more attractive because they're higher because of a lower tax rate. So a lot of things like that. On the small business side, they say that credit quality is great already, but it's actually should get better because the tax rate's coming down. So you have all this extra additional free cash now on the small business side. And this is especially where it's important because a lot of these small businesses only exist in the United States and they're paying the top tax rate. So if we actually have we're talking to a representative from one of these small businesses in the United States, and they said, they're going to be a huge beneficiary of this tax bill. And so I think that's where you see the benefit, and that improves credit quality, because if you look at, the debt to EBITDA ratios, debt to net income ratios we'd have to use, that is going to be lower because the net income is going to be higher.
Yeah, and I think that's you're touching on a lot of themes that I think we're really going to be having to watch and really listen and discern from management teams in terms of what's happening. I mean, JP Morgan kind of took, as you said earlier, not a whole lot of micro commentary given there. They have Investor Day in February, but for the most part, they're kind of relaying a bullish, broader market sense and saying we should benefit from this. Because of that, and because of how JP Morgan's operated over the last couple of years, and they've done a nice job of that, to some degree, you have to take them at face value, and the stocks, we're adjusting our price targets upwards slightly, to kind of accommodate that as well as the run that the company's had. But it's not necessarily a given, and I think that's going to be something that's going to be interesting as we kind of continue to hear from other companies.
And part of that price target move is not even so much the tax rate, which does play a role because the earnings are going to be higher. But it's also the idea, for the longest time, these companies, after the financial crisis, they traded at it based on tangible book value. And usually it was a discount to tangible book value, which is what are the actual assets, not including any goodwill, intangibles, brand, or whatever. And then you kind of saw this shift happen, and then it was trading at a multiple to tangible book value, or about book value itself. So now you're starting to include all this goodwill. But you're still buying the bank for the assets it has, for the actual deposits that it has and the loans that it has. And now you're kind of seeing this third and final leg come through, and that is you're seeing them trade more similarly to other companies, and that is as a multiple of earnings.
Right.
So you look at what the company's earning, and then you give them a multiple. So you're moving away from this idea that a bank's value is based on what it actually has on its books, and you're moving toward a valuation world where you're valuing the company on what it's earning.
Mm-hmm. Which is kind of a natural maturation of this process. If you go back to 2008 and think of the mindset, you almost had to say, well, what's the cheapest we can get this? What do they actually have on their balance sheets? Because that was such a problem during the financial crisis. And then as you kind of mature towards where you are now, it's almost ridiculous to think of the economy being where it is, interest rates going up, which obviously benefits banks on practically every level. We've discussed that before. All these factors at play, a beneficial tax bill, as well as increased earnings. To only value it relative to tangible assets would be a bit of a misalignment. So it's kind of a logical progression there.
Yeah, but at the same time, it's really interesting because you could make an argument that these banks could be valued really double what they are now if you value them as a franchise like you would value a Starbucks, for instance. Or you could also say there are no barriers to entry. I could make a loan to anyone, and then and I could be a bank, and I could start taking clients from JP Morgan. But the idea now, I think, is that there's enough regulation and there's enough franchise value at these big banks that you can pay a multiple of earnings for them.
There we go. Any other closing thoughts or read-throughs on JP Morgan?
I'm looking forward to seeing what Bank of America, Citigroup have to say. I'm also really interested to see what happens at the other banks in terms of their economic outlook, because I know Citigroup in the past has been much more bearish and more reticent to assume good economic growth. JP Morgan has historically been a little bit more bullish. Jamie Dimon isn't afraid to make bold statements. Citigroup's a little bit of a different animal, so I think what an analyst should do if they're looking at these banks as a way to forecast what the economy is going to do is kind of take Citigroup and what JP Morgan has to say and kind of split the difference.
There you go. All right. This is the Investing Podcast. We'll talk to you guys soon.
Tusk Media is a subsidiary of Narwhal Capital Management. Ratings and reviews of Tusk Media content are not to be construed as endorsements of opinions, analysis, or services offered by Tusk or its parent company. The opinions and predictions shared here are our professional beliefs at the time of publication. We are not under duress from any of the corporate entities mentioned. This is not a solicitation to take any particular action. Although we are investment advisors, this information should not be considered investment, legal, or tax advice. We strive to be as impartial, insightful, and accurate as possible. We base our opinions, analysis, and calculations on information we believe to be reliable, but we cannot guarantee its accuracy. We can, however, guarantee that our opinions will sometimes be flat out wrong due to a variety of factors. Employees and clients of Narwhal Capital Management may or may not hold positions in the securities detailed and may or may not hold these positions in the future. A full list of all securities purchased, sold, or held during the 12 months preceding the date of this publication can be provided upon request. Unless otherwise noted, all data accessed via MarketWatch or the Bloomberg terminal. Past performance does not guarantee future results. A copy of Narwhal's Form ADV is available at the SEC's website, www.advisorinfo.sec.gov, or from Narwhal upon written request.